Dave, thank you for taking time being with us today. Tell our listeners a little bit more regarding your background and how did you get into real estate?
How did I get into real estate? I was working in construction, and I was living with my mom, with my wife and son, and I would come home every day all depressed. And I was about 25 years old, and my mom said, "Why don't you try going into real estate?" And I went and got a real estate license at age 26, and then later on got into investing. I actually started out buying properties with credit cards. And I would buy a house with a credit card, fix it up with a credit card, move a tenant in, refinance the house, pay the credit cards back, get the house for free, cash flow, and then I would rinse and repeat, do it again, the properties. And at one point, I had about 11 lines of credit. And then I started using that money to renovate property. And then I became a lender. I started lending money out.
So, and what made you do the transition? Why did you start it on the debt side, so to speak?
So I got into the debt side by accident. I was, I started out. I was actually a property manager at a Remax Realty, and I was managing a bunch of properties, probably over 100 units, and I had about 40 doorways of my own. And then on the other side, I was lending money out to other fellow rehabbers who were rehabbing property. And I was like, this lending is much easier than this managing. And then because you don't have tenants or toilets or any of that stuff, and you have a homeowner mentality instead of a tenant mentality. And then the other thing was I ran a real estate investor networking group. And I used to interview the speakers that would come to the group. And one of the speakers was a gentleman out of New York City who was raising capital for distressed debt. And I said, that's interesting. And I didn't do anything for about 3 years. But my one partner did. My partner, John, did invest money. And he was making pretty good returns. And right before the real estate crash back in like '08, in fact, it was 10 years ago this month, we've been in business. He was like, hey, he was a lender, a loan officer, and I was a realtor, and we could tell the market was getting ready to tank. And we were like, hey, what side of the fence do we want to be on? And that's when we kind of said, hey, let's work this distressed debt. And we reached out to the gentleman out of New York, and we said, if you teach us how to collect on distressed debt, we'll buy assets from you. And then the rest is kind of history. We started out in the beginning with our own capital, and then later on, started raising money. And one of the reasons my partner John connected with me was because I had previous experience raising capital for a lot of commercial real estate deals. So I kind of shifted from raising money for commercial real estate into raising money for the note space. So we specialize in 1 to 4 family residential. So that's our space that we play in.
Because from what I hear, the distressed debt funds, at least a huge chunk of them, actually did well in '07, '08. Can you clarify this a little bit on this one?
Well, I mean, whether a fund does well or not is a lot of different factors. Some of it is what is their ability to find assets, what is their cost of capital, and what is their execution. So not all companies are the same, and they're not all strong in all those areas, right? So there's companies that went out of business then too, just like they go out of business now. So it's, but there was plenty, to your point though, there was plenty of distressed debt after that. There is a little bit of a time lag with debt from the real estate market. A lot of the loans we buy are delinquent for 3 years or even 5 years. Our record's 10 years. So sometimes the debt we buy has been delinquent for a while. But yes, there's, I mean, in a down market, you see a lot more product. In an up market, there's a little bit less product because it is somewhat of a supply and demand equation.
Sure. But
so a lot of times your strategies are different on your exits, depending whether the market's an up market or a down market.
Gotcha. But being on the debt side, you are dependent on actually people not defaulting on you and actually also getting deal flow. I would like to know first, how do you get the deal flow? And because if people are kind of happy to getting rid of what they have on their portfolios, that means that you must know something that they don't, because you must have a way of collecting that. And that brings me to the second question: is how do you collect that from people that probably it's a bad debt?
It's a great question. I mean, we get it quite often because it's, the first, you're hitting on a bunch of areas, right? So the first area is, how come the banks don't do what you do? That's really what you're asking. And one of the reasons is they're in the lending business. They're not in the collections business or the loss mitigation business normally. And their expertise, they make their money lending money. And their default rate in their portfolio is a small percentage. It might be 1% in a normal market, maybe 2%. And then in a bad market, it ticks up a little bit. So 90-something% of the time, they're getting paid on their loan. And they're in the loan for a large sum of money. They might have originated the loan, or they might have bought the loan performing. So the bank is typically highly invested into that deal. For us, we're buying the debt at a discount from the bank, and we have collections data they don't. Especially on, like, our specialty in the beginning when we first started was junior liens, and a lot of times the junior liens weren't covered by equity all the way. So we knew the collection data and the outcome of that. So in some ways, we're a data company. My one partner, John, actually runs our acquisitions and data team, document management. He oversees licensing. So his departments are different than mine, right? So a lot of times we have, today we have 10 years of data on collections and the outcome of assets that a typical bank wouldn't have that data. So we know it becomes the DNA of our business, right? We have information that they don't have on outcome of collectability. So they can go in and analyze a tape of assets very quickly, determine not only what it is, but how it'll perform based on past history of assets that were similar classes and categories. And that's really our proprietary special sauce, so to speak.
Sure, but what I'm interested to know is, on a practical level, how do you actually collect money from a person that might have kind of a distressed life, for lack of a better word?
Well, you did ask that. So on the collection side, on the loss mid side, it's a little bit different. Like, we're a little different than a bank, right? A bank is into the loan for the full amount typically. Their model is more like pay up or get out type of conversation with a borrower. Ours is a little different. Ours is more like, what happened? Where are you at now? What would you like to do? Let me help you do that. Meanwhile, legal's moving forward. So it's a different vibe right out of the beginning, different philosophy. And we've bought the asset at a discount, right? So we can do things that a bank can't do. And a lot of times we'll share conversations we've had with other borrowers. For example, we might say, hey, we had a family in Oregon. They were able to access their 401k penalty-free, and corporate accepted an amount less than what was owed. Is that something that would interest you? And they might go, yes, or they might go, no, I don't have a retirement account. Great, maybe you're qualified for our friends and family program. We had a borrower in Delaware who the niece asked her uncle for the money, and he lent her the money, and corporate sold the loan to the uncle. And maybe the uncle's more inclined to lend his niece the money to take care of this situation, especially now that he's a secured lien holder. Maybe he would have lent her the money anyway, and maybe the borrower will say, I don't have any friends and family, nobody likes me, who knows. Great, maybe you're qualified for a discounted arrears program. Do you have an income tax check? Do you have an insurance policy? Do you have any other assets? So we go down, not only do we address the payment, but we'll also address any arrears or back taxes, those types of things. So it's always this dual conversation, but really our goal is to, we really want to help people stay in their homes if we can, and if we can rework the loan and modify it in a way that makes sense for both sides. Our goal is to always leave them in a better place than where they're at, even if that's where the thing is move on. It's still better than leaving them in a bad situation where a bank might just take their house from them or something like that. So.
Sure. And what's the typical holding period for the note?
You mean a reperforming note or a non-performing?
A non-performing. I mean the worst. Let's say that The typical deals that you like, that you guys kind of go forward, what's the typical holding period for that note? So how long do you carry it and get interest from it, and then get rid of it, so to speak?
That's a good question because it varies quite a bit. And the reason it varies is, first of all, on a non-performing note, how long we hold it or work the asset. Usually we're working the assets, and most of the time, a lot of that's dictated by foreclosure timelines. So our loss mitigation folks are specialists in certain states, and they're very well versed in the legal and the timelines. So, in fact, they're very well versed in that, and we hold our attorneys accountable. We work with a lot of law firms throughout the U.S. So it's so a lot of that's a surveillance of the attorneys. So that's one piece of it. So, but the other piece is, once a loan's reperforming, how long do we keep it? Is more a factor of what type of market it is, right? So in an up market, we tend to hold assets more. In a down market, we hold them less. And I think that has to do with, in an up market, as equity comes back in the market, the value of the assets increases, just like the longer the pay history is. So if it's performing for a year or 18 months or 2 years, the asset becomes more and more valuable. So a lot of times we tend to hold more of those assets. In a down market, we tend to sell, we might sell everything in a down market. So there's more product to buy, and you're kind of blowing through product. In an up market, you tend to hold more product. So the beauty of that is, sometimes you can collect payments on a note for a couple years, 3 years, 4 years, 5 years, and actually sell the note for what you could sell it today for. So that could be some of the reason that we hold some of the assets. And it also has, it depends on how much capital we have, right? If we need capital, we can always sell assets. We can typically sell a loan in about 15 minutes. So for us, it's a very liquid investment. But if we don't need capital and we're raising a lot of capital like we do today, we don't need to sell everything. So it's kind of a function of those categories of, do I need capital? We don't want to sell an asset. I mean, think about it. If you were a fund investor of ours, would you want us to sell assets to note buyers where the upside would go to the person we sold it to instead of the fund that you were in, right?
Sure, sure.
I mean, it makes sense, right?
So, but what I wanted to be clear on is that, let's say we are investing today. I would like to get clear on kind of the ballpark average returns that we would typically expect, and the typical deal that you guys look at and say, this is a typical deal that we are happy to move forward. This is something that I wanted to be clear on.
So what type of returns can you expect from a note or from the fund?
No, from a note.
Or from both? Well, today, it's funny you say that, because we're in a little bit of an up market, we're seeing the returns of the note tend to be less than what the fund pays.
Okay.
Previous markets, the notes paid a higher return than what the fund was paying. So for many years, the note would have a higher yield than the fund. Today, we're seeing it shift, and it's because the market changed. In a down market, a lot of times you'll see notes with high yields, and then in an up market, the yields on the notes are lower. But you also have to keep in mind that when you get a note, you're getting a principal and interest payment, whereas if you were in, say, our fund, you're just getting a preferred return, and then the full amount balance is due at the end of that term. So you're not getting a principal and interest payment, you're getting a preferred return payment, which is more like interest.
Sure. What I meant was, let's say you guys are really experienced, so you run through all sorts of deals, and that there are some of them that you really don't like, and there are some that you do like. And I would like to understand is, what's the typical deal that you guys do like? This is something that I'm really happy to understand.
Oh, you mean what is our sweet spot of product we like to buy?
That's exactly what I asked.
Well, I mean, some stuff's a little proprietary, but in general terms, I mean, we like 1 to 4 family residential. We buy first and second mortgages. I would say most of the first mortgages we buy are probably between $50,000 and $250,000 loan
Okay.
balance upon origination. And a lot of that is factors of the marketplace too, because a lot of your larger balance first mortgages are bought up by larger funds. When it comes to junior liens, what do we like in junior liens? Most of the time we like, I would say, less than, a junior lien that's probably under 250,000, and probably where the first lien is under 350,000 or so, because if it has a large first mortgage on it, it could have a large reinstatement fee. And we prefer loans that are, or we can buy more loans and get more swings of the bat. That's kind of our model. Now, everybody has a different idea of what they like there. I mean, with junior liens, sure, we like liens that are current on the first if we can get them, or high equity liens, those types. But we like all the above.
And
But we don't really buy unsecured. We don't really like unsecured debt, that type of thing.
Yeah, this is why I was asking, because as from a point of an investor, we want to make sure that we have the principal secured and having a steady cash flow. In order to do that, we have to understand exactly where we are getting ourselves into, so to speak. And on that note,
yes.
On that note, I would also like to hear your thoughts, since we are coming for a market correction and cap rates are getting a little bit compressed now. At least from the deals that we're getting from brokers, we're seeing everything is uber expensive. So on the debt side, I would like to understand how does this work now?
I guess is your question about supply, you mean?
No, for the future. So at this time, since every syndicator and sponsor is saying, oh, I can get deals now because deals are getting super expensive. And the other side of that coin, meaning the debt, I'm interested to know what are your thoughts on the current market and the typical deals that you have. How does this play out for you guys from the debt side? This is what I asked.
Well, I think it's which side of the equation you want to complain about, right? So I could say, well, pricing's up on what I buy, but my whole portfolio just went through the roof.
Sure.
Right? So I could argue that, well, maybe I'm more of a seller in a market that's real high than I am a buyer, maybe. Or but we tend to, I don't know, maybe because we're larger today, we don't seem to have a problem buying. On the retail side, I do hear people saying there's not as many assets to buy. It's harder to find assets. Part of my answer to that is, well, where were you 5 years ago? There was plenty of assets, right? We were selling everything. So they're getting to the market late in some cases. But also, as the market gets tighter, if it's an up market, the assets tend to stay at the top and they don't trickle down to the retail level as much. That could be it. So, but as for us, we still see plenty of product. Raising capital and the product side is not our biggest challenge today by any means. Ours is more on the, execution, growth, that type of thing. Throughput, handling more throughput. It's actually the opposite of that. So for us, it's really not a supply problem. I know when we first started the business, our biggest thing was capital. And then later on, it was sourcing, like you're describing. And today, that's not really our issue. Our issue today is probably more on, leveraging technology and capital and things like that. So we're more in a growth mode right now. So, but yes, I do know there's people in the marketplace that are, it's harder for us to find product, or pricing's harder. But some of that is efficiency too. How efficient were they to begin with? That type of thing.
Dave, for the future, where do you see yourself and your company heading forward?
Well, we're pretty optimistic. We're into software. We've hired a lot of consultants. We've upgraded all our compliance. We've moved into larger facilities to hire more people. So we feel we have sourcing and capital under control. Our thing is all about growth, all about scaling up. Our goal is to have $1 billion under management. We're well on our way to doing that. So we're pretty optimistic right now. We still see a lot of product coming from the government entities, the GSEs. So we're pretty excited. We have a lot of good things on the horizon. We are also looking at crowdfunding type platforms. So we know we're well positioned to take advantage of the future here.
Cool.
whether there's an upturn or downturn. So either way, we do well. So
Cool. And on the other hand, if you were to go back and advise to your younger self, what would you say to me?
I would have stayed in commercial real estate. No, I'm like the well, I mean, we kind of went through. If you think about it, we went through one of the most difficult phases, and obviously we're still here, right? We've been in business 10 years, so we were in an up market. The market tanked. We survived, right? We're still here. So it's people. I often get that question about the next downturn, the next crash, all that stuff. But I don't really foresee a crash quite the one that we saw. It was almost like a perfect storm of the real estate market tanking in 2008. And it reminds you back of the stock market crash in 1929. For a long period of time after that, the government stepped in and did a lot of things to prevent a stock market crash. And I'll bet you it was the next 50 years where you didn't really see too many ripples in the stock market. It's similar to that in my head, where the government has put some measures in place. Now, will it be another 50 years? I don't know, but to be quite honest, some of the economists I talk to, they feel that we're not going to see a crash, real estate crash like we did in our lifetimes. We just don't believe we will. Now, that doesn't mean you're not going to see some bubbles here and there, in the California market or this market or that market. Real estate's very geographic, but we're pretty well diversified amongst the whole U.S. We have product in all 50 states. We're probably, most of our portfolios in 25 or 30 states. So we're never really in just one area or one market. So I think we're pretty well positioned for that. And if there is a downturn, well, there's cheaper product to buy. If there's an upturn, our portfolio goes up. So it's like, I don't know. I think as long as the margins are still there, which they tend to be, there's always people defaulting, right? Because they default for death, divorce, job loss to medical. So you would have to say, I anticipate divorce going away, or I anticipate, but the big economic driver for us is really jobs and economic growth. If there's no jobs or there's not much growth, that's when you'll see a downturn for us, really in the job market. So I don't know that that's going to happen, and I kind of hope it happens in some ways. Although I don't, I don't hope it happens for the country or anything. But if there is a downturn, there's just going to be more product for us. That's all.
Gotcha. And regarding books, because I'm a bookworm, I read like an insane person, and I like to share books with people. So I'd like to know, what kind of books have you been reading lately that you'd like to share with our listeners?
Wow. I read a lot of books, probably 20 to 25 a year. So I guess for my company, some of the biggest books I've been reading is Scaling Up, Traction, those types of books. I'm a big Vern Harnish fan with Gazelles. I'm also a member of Birthing at Giants. There's a great book by my one coach, Lewis Schiff, called Business Brilliant. There's a lot of data in that book. But I also like a lot of other types of books as well. I recently was reading the recent Tony Robbins book on money. I like, I'm trying to think, I like a lot of financial planning books too, like, like Misfortune 101, those types of books. So, yeah, gosh, I love to read. I read every day. And, sometimes I read so much I can't even remember what I'm reading.
Me too.
I'm reading a book called Street Smarts by Norm Brodsky right now. I enjoy that. It's about, a lot of them are business books. I'm not much of reading the classics or anything, but I'm reading a book called Crowdsourcing right now that's been enjoyable. So yeah, I'm always reading all kinds of stuff, and I listen to a lot of podcasts too. I listen to Tim Ferriss' podcast. I listen to NPR and Planet Money and a bunch of podcasts when I'm riding in the car, and I do enjoy that type of stuff as well. And so whether it's an audio book or reading a book, I'm always doing something. I'm actually finishing up a book that I'm writing called Note Investing Strategies for the Real Estate Investor. I'm actually doing in conjunction with Ingram Books through Bigger Pockets, which is another podcast. And that's supposed to come out in the spring. So I enjoy doing that. And really, I enjoy anything that has to do with helping other people share, build, and preserve their wealth. and some of the groups that I run do that as well. So I do hold events for high net worth investors, and then I also have a real estate event coming up in the spring in Philadelphia, which we're in the middle of planning right now. So it's been exciting, a lot of fun.
And finally, where can our listeners get a hold of you if they have any further questions?
Probably the easiest way is through our website, which is PPR Note, NOTECO.com. You can easily get a hold of us, contact investor relations. They can get through to me, or you can actually set an appointment with those guys. You can call in. More than happy to help you. We have big on customer service. We're big on someone answering the phone or setting an appointment with you, whereas some companies lack in that area. But we do like to, and people can ask me a question anytime about any type of real estate investing or planning or any of that stuff. I've been doing this a little while, so I get a lot of fun answering people's questions.
Gotcha. It was wonderful having you with us today. Hope to speak with you soon.
Thank you. Thank you very much for the opportunity. Good luck now.
Thanks.
Thank you.